Hey guys, welcome back to another episode. Today, I want to take a closer look at a lot of things happening in the market. Obviously, first is going to be Nvidia and this overall sell off. I just want to share my overall thoughts. Then, we also do have some reports coming out that Meta and Google have made a form of AI chip deal, which has me having a lot of questions. And then finally, I kind of want to end this episode looking into Coreweave. Coreweave just reported earnings. The stock is down roughly 8.7%. So I want to share my overall thoughts there. So let's take a closer look in today's episode.
I want to thank the Motley Fool for sponsoring this video and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right. So first, let's just start off here with Nvidia and this overall sell-off yesterday. And this is going to be short, right? Don't worry. I know people are going to be like, Jose, is Nvidia all you talk about? Well, it is a big position in my overall portfolio. But like we mentioned, we have other things to discuss. I just want to say with this 5% sell-off, I think it's extremely crazy. I mean, if we look at forward PE ratio, right? Forward PE ratio for the stock right now is roughly 22.38. And this is that we still haven't gotten all the analyst updates. Remember, forward PE ratio is based on analyst expectations for the next 12 months in forms of earnings. Now, most of them, I'm going to say probably over 80% are not even matching, are extremely wrong. So in the upcoming days, especially after the guidance beat that we got from NVIDIA, I think we're going to see updates on this even more and more. And I think this forward PE ratio is going to start to look even closer to the 20s than it is right now. So for me, if I didn't have a massive position on NVIDIA, I would think this is as an extreme gift, right? I do believe the opportunity in the AI market is here. Now, for owning obviously a $4.5 trillion company in this AI space, it's like, you need to be extremely bullish in this industry. You need to think that 2020, this year, right? 2026 CapEx is not the top for revenue. It's not the top for CapEx. It's not the top for earnings. And if you believe that, then I think holding NVIDIA is going to be an easy feet. But if you don't, if you have worries about the AI market, I think obviously owning the big player in the space is going to come with a lot of uncertainty and doubt. So for me, it's going to continue. I'm not trimming any of my NVIDIA on any fears of the AI market. I think the AI market is going to continue to grow. But yeah, I actually think this is a massive opportunity. And over time, at these levels, I don't mind adding more and more and more, but a little bit for me already. Like I mentioned, it's all about portfolio allocation. I already have a massive position, way below cost basis than anything we're seeing right now. So it's no rush for me. But as dollar cost average over time at these levels, I think is an opportunity. Now, the next thing I want to jump into is Meta, right? So today we did have some reports that Meta and Google, this is the report here. So first we had reports that Meta scraps advanced AI training chip Olympus due to design struggles. The information mentioned. So they're no longer going to do ASIC. None of this is confirmed by Meta. It's all reports. Then outside of that, we got reports that Google signs a multi-billion-dollar TPU deal with Meta platforms, right? So we saw a little bit. So they stopped their ASIC solutions and they went with somebody else. Now, obviously, the optics of this, the way after earnings and all this negative things, is like, is this a threat to NVIDIA? Now, I was curious to see how stocks would react to this. No one's really reacting. Meta's down about 0.7%. Google's pretty much flat. Broadcom is the one that designs these, right? So you would expect them to also see some results here. But this one's also down 1%. So no one is getting any benefits from this announcement. Now, Amit, obviously a great friend of the channel, posted something. He kind of gave us the information, and at the end, he kind of shared that he doesn't believe this is bearish for the semiconductors companies like AMD, Nvidia, and so on. He just thinks Meta just needs that much compute. And if you've been following this channel, you know that that is my thesis as well, right? I believe the demand for AI is so high, and that's why you're seeing so many different companies make multiple deals with multiple chip players. So I agree with Amit that I wouldn't see this negative for other chip players like AMD or Nvidia. I mean, they just announced a deal with AMD earlier this week, right? So it seems that Meta just needs as much compute as possible. But I am going to say, right, this is where people might think I'm a perma bull. I am super excited about the AI industry, but it is weird. And I have a few questions, and I would love for you to answer these questions to hear your overall thoughts. Sometimes I might be overthinking it, but if Google, right, Alphabet is so compute constrained, and if you look at their prior earnings, right, the one they just reported a little bit over a month ago, they mentioned they believe they're going to go 2026, continue to go compute constrained. Now, these AI chips, this deal is expected for next year, right, 2027. But why give up compute to another player if you are compute constrained? Wouldn't you want to keep all that compute for yourself to grow? So, what is the reasoning? Like, why would Google give up the compute if they are compute constrained? Now, in my opinion, there could be a few reasons. One of it could just be Google just wants to diversify and want to enter a new market, right? That could be rule number one. And that's okay, right? I just want to hear other people's thought. Um, the other thing is that does it not expect to be compute constraint next year, right? Is in 2027 when they're going to sell these chips, do they think that they're not going to be as constrained as they are right now? And they're just selling any excessive chips that they might have to Meta, right? Because for them, if you are developing AI chips, you want to continue to have the supply chain market, right? You want to make sure you have great relationships with the memory players, great relationships with the manufacturers, because you don't want to slow down one quarter or 1 year and then meet them again next year. And then someone like Nvidia and AMD kind of take your spot in the supply constraint space, right? So is it just that they're just trying to find a way that if they needed less chips next year, they don't want to give up their supply constraint and kind of enter that market, which I think it is also possible. The other thing, in my opinion, could be that Google has limited amount of power and space. We hear power shells is it's a limiting factor. Eventually, it's going to be a limiting factor. They believe that's going to happen in 2027. And Google has to decide, what do I fill with these data centers? Do I fill it with GPUs? Do I fill it with TPUs? Did it decide to fill it up with GPUs and any extra TPUs kind of sell it off here for Google? So to me, the big question seems bearish. Like if Google is so compute constrained, why give up to other players? Why give up that compute? I don't necessarily think it's bearish, but I would have loved to understand the reason for it. Unfortunately, I don't believe anybody is going to tell us what the real reason is. Now, if you want to learn though about the AI market and the semiconductor market, I definitely would say check out my overall community, whatthechiphappened.com. We have a lot of great investors. A lot of people are going to share their thoughts there. We have a lot of great earnings deep dives. We have exclusive live streams. We have conference coverages. We have a community of like-minded investors. If you are serious about AI and semiconductor investor, go to whatthechiphappened.com. Click this link and you get 33% off at checkout. All right. So I have some other topics. So we talked about that Google and AI news. We also had Amit over here share some great news that Anthropic milestones as per the information. Daily signups have tripled since November. Paid subscribers have more than doubled since October. Free users have grown 60% in the last month. And at the end of the day, this continues to solidify that demand for AI compute, right? I think that's what we're going to continue to see. I mean, Perplexity yesterday announced something pretty cool, right? Perplexity Computer, which is a computer that unifies every current AI capabilities into one system. It can research, design, code, deploy, and manage any project end to end. I haven't tried it out yet, but based on the video, it looks pretty amazing. And again, the compute needed for this, and when more people use it, the compute token exponent is going to grow exponentially high. And as more tools get used and as more time gets used, the demand for compute is extremely wild. Now, the other thing I want to talk about before we get into CoreWeave is right now there's a lot of news of Block, right? XYZ, whatever the company is called now. It laid off about 40% of its workforce thanks to AI, right? That's what the company is saying. It's because of 40% of layoff by February, and I think it's about 4,000 people, because Jack Dorsey is saying that AI is enough. AI and 6,000 is better than 10,000 people. That's how AI is evolving. Now, I personally believe the way it seems is this is more of AI, a software company or a company just being over bloated with employees that aren't doing anything. And AI is the easy route to kind of escape this. Because I agree here with James Wang, who is the director of product marketing at Cerebras. He was previously at Nvidia, previous at ARK Invest, and previous at 21 Shares. He says there is no example in history when technology invented in December caused a 40% layoff in February. Prior to December, right? Prior to December, AI agents really wasn't a thing. Even Claude Code, right? I think that was hitting more in November. Still November, right? But I don't think that would cause somebody to sell off or lay off 40% of your employees. This is something that he's thought about in the past. He had too much employees. I was just in a live stream with Neil when we looked at Coreweave. He mentioned it pretty well. I mean, X, right? Twitter. It seems like they were over bloated. That was a company here that Jack Dorsey had, right? So maybe he's just not good at running businesses. But unfortunately, the optics has created this negative sentiment. I mean, we saw a lot of sell-offs in software stocks. Microsoft was down about 1%. Salesforce, for example, was down roughly 2.5%. And the market, I think, is seeing that, look, if AI is going to be, which is weird, right? So it's like you're going to lay off employees because of AI, or is the AI story really it? Do you have competition? Like it's the AI SaaS apocalypse doesn't even know what to go with, right? And it's creating that fear here on a lot of different companies. This is another thing that I believe the optics is going to look scary. I think as we continue to see layoffs in certain industries within the next few quarters or months, the easy escape route for CEOs and everybody is going to say it's AI making us more efficient and we need less players. I think those businesses are unfortunately on the lower end of success rate. I think if AI is giving you massive opportunities, wouldn't you want to keep all those engineers and all those tasks and all those people and just incorporate AI and become a way better company than you are right now? And that's what I think. There's going to be two types of companies. There's going to be the companies that are going to be laying off because of AI. And I think the optics is going to create more negative turn to the AI industry and to AI stock investments, especially the SaaS market. But then I feel that the real winners are going to be the ones that are investing in more talent and that talent being able to grow even faster thanks to AI innovations. We saw here that Autodesk, right, reported a massive quarter 4 revenue growth. And it's an easy indication showcasing that the AI story is not going to eat up the software market. But yet the industry or the optics is going to look very negative. Now, the final thing I want to end this episode with is CoreWeave. So CoreWeave reported earnings and the stock is down roughly 9% after hours. Now, I joke around because I've been a CoreWeave investor for most of CoreWeave's public life. This is nothing, right? Right. This is, we were just a month ago. We were at $74. So if we're sitting at $89, these are prices we last saw on February 20th. This is a market that's very, very volatile, right? Extremely volatile. And again, once you're in it for some time, I think you get a bit immune to it. 89 for me doesn't seem like a scary drop. I don't know if I'm just a little delusional here, but I don't see 89 being a scary price. Now, I want to talk a little bit about earnings, and I think earnings were great. It did continue to give me that long bullish thesis that I do have for CoreWeave. And for me, for CoreWeave, as you guys know, I'm very bullish in the AI market. So I want someone that is kind of being very aggressive in AI infrastructure buildouts. And it used to be Oracle, right? Oracle used to be the one I used to enjoy. But that has turned over recently to CoreWeave, and CoreWeave has become my best player here. And that's what I'm getting, right? You're getting a company that sees the demand of the AI market and they're going all out. They're going extremely all out and they're seeing huge revenue growth and they're seeing huge active power being turned on. And in regards to that, though, they're going to see huge debt and capex, and they're going to see because you're spending so much money at one time before revenue is turning on for some of these data centers. You also see some ugly things in margins. I think eventually that will be fixed because the demand is just so out there. Now, I wanted to showcase some of the things. So overall, I'm pretty excited. right? But I understand the risk. I'm looking for that aggressive player. Some of the things that investors should know is their revenue backlog was 66.8 billion. It jumped 11 billion sequentially in quarter four alone, and it's up over 342% year over year from 15 billion at the end of 2024. That is wild. That is extremely wild. They also announced new customer wins, including CrowdStrike, Cursor, Mercado Libre, Midjourney, Runway, plus expanded relationships with existing hyperscaler cloud customers. 2026 guidance is about 12 to $12.5 billion, which would be 140% year over year growth rate. Some people might say, wait, isn't that the same type of number some other players provided? Remember, this is revenue and not annual reoccurring revenue. I think pure revenue, this is going to be at least 2 to 3 times larger than the second player in line. CapEx, $30 to $35 billion, which is massive. Active power expected by the end of this year is 1.7 gigawatts. This is active power, not contracted power. Big difference there. Revenue for quarter one expected to be around $2 billion and capex around $6 to $7 billion. So this company is investing strong. Now their long-term annualized run rate targets for 2026 is $19 billion on the top end, and they mentioned for 2027 they expect it to be over $30 billion. So again, to me, this AI story is going to last. If you believe the AI story is going to last, I think this is one that one can hold and not be too fearful of. But obviously, if you're worried about the AI market ending soon, then Coreweave is probably not the company you want to own. Some other things that I want to talk about is they talk about their total contracted power. They now have about 3.1 gigawatts secure, and virtually all expected to come online by the end of 2027. Other players have about 3 gigawatts, but I don't think they gave a date of when all of it is going to turn on. They're also the first cloud provider named an Nvidia exemplar cloud for training workloads on GB200s and VL72, optimized by Coreweave's mission control. They're even providing and entering into AI object storage. They are also entering into kind of cloud solutions, their software solution capabilities as well. So they're definitely finding ways to increase their margins as well, which has me pretty excited. The main reason is a lot of this guidance excludes any potential revenue or margin benefit from further monetization of Coreweave's proprietary cloud stack to other NVIDIA cloud, enterprise, or sovereign customers, described as a tangible long-term potential upside. So I mean, I liked it. I do think they were a bit conservative with their guidance in revenues, especially if they start to see stronger growth in their storage solutions, in their cloud solutions, in their software solutions as well. And I think this is actually going to grow pretty strongly this year. So I think they were conservative in guidance. The debt story, obviously massive capex. That's what the market is scared of. Hey, how are you going to pay for all this capex? You're spending about $500 million in interest per quarter, right? So that's scary. But at the same time, they are mentioning that they are increasing or improving their financial story. They did about like a 300 basis point improvement, which saves them about $700 million per year due to the financing improvements that they're doing. And it's expected to get better and better. So again, I like it because it's that aggressive play in the cloud market. Now, I will be doing a deep dive on CoreWeave for the community, so make sure to check out whatthechip.com. And if you want great charts like this, fiscal.ai/Jose, get 15% off if you lose my link. So not lose, use. Take care, have a good day, and see you all next time.